Good evening, I'm Richard Gonclaves. Welcome to the Thursday edition of Market Moves. The bottom market movers by index weight, the main reasons why the market fell. Westfield, the biggest drag. To the upside though, BHP Billiton, it tried to put on 9 points on the overall 14-point decline on the S&P ASX 200 today. Roger Montgomery joins us in the studio to tell us exactly what moved the markets. Volumes relatively low, the market not volatile at all. Is this going to be a theme we're going to see over the next couple of days because we're going to see Wall Street on holiday?
Well, it's been a feature for several months now. This rally that we've seen, particularly in the US market, has been on lighter and lighter volume. I don't know what that means. People tell me that it means that there's not a lot of conviction in the rally, but prices are obviously the prices that they are. It's interesting to watch what's happening in the market at the moment. You've got record low interest rates, particularly in the US. We've been told by the Fed in the last week that interest rates are going to stay low till 2012. On top of that, you've got massive fiscal stimulus. You've got enormous amounts of money being pumped in. That money goes somewhere. Invariably it does. Almost at the end of every decade for the last 4 or 5 decades, we've seen an asset bubble in some asset class. At the moment it looks like it's stocks, but if stocks get too far ahead of themselves, and I've said this before, that I thought the market was expensive, and in fact it's consolidated since those statements, then what we'll probably get is a rally in commodities, and we're seeing it in gold at the moment.
One email that I get consistently from viewers of the same theme is, they want to know what's going to happen in the lead up into Christmas, because we hear the word.
It'd be great if I knew. I wouldn't be here, mate.
But based, I mean, you've got your theory in terms of real market value.
Sure. I
mean, putting that into the combination and the mix of things, and what you're seeing in terms of the market consolidating right now, do you think we'll see this so-called Santa Claus rally? Well,
it's difficult to predict. But there's going to be no change to the money side of things. More money is going to be pumped in. That seems to be the case. There seems to be a little bit more confidence coming through from Australian business today, and so as a result, I suspect there's going to be a fair bit of optimism. Now, I don't know how that will translate to prices. The market does seem a little bit expensive. If interest rates stay low, which certainly seems to be the expectation globally, then it's going to be really interesting to watch, because in Australia the pressure is for interest rates to rise relative to the rest of the world, but as interest rates remain low elsewhere, then that's going to keep stock markets buoyant.
Okay, I'm glad you mentioned interest rates. Capital spending on new buildings and equipment unexpectedly, you knew what I was going to talk about, plunged in the third quarter, dropping nearly 4%, where economists forecast a 0.2% drop. CapEx totaled $26.5 billion in the third quarter, down from around $27.6 billion the previous quarter. Companies' capital spending plans for the current financial year are down 7.7% from the previous year to $105 billion. The figure will factor into the RBA's thinking when it meets next week to consider whether or not to lift interest rates. I mean, this is another piece of economic data. What's the market saying in terms of whether or not we'll see an interest rate rise in the first of December?
Let me give you some interesting research that I did many years ago. What I did is I plotted the cash rate over 10 years. I might bring it in next time I'm on. So I plotted the cash rate in Australia for 10 years, and I did it in Europe and the United States, across all countries. And then what I did is I took the futures yield curve, which is a prediction of where interest rates will be in 30, 60, 90 days, 10 years, so on and so forth. And I plotted that yield curve over what actually happened to interest rates. Not once did the market's prediction ever prove accurate in terms of where interest rates actually went. And of course, the further they went out, the more wrong they were. Since that time, since I conducted that research, the yield curve has been pretty flat. So it's almost as though the market can't tell whether it's going to go up or down. They've just sort of given up. Given that, I think investors shouldn't worry too much about whether next month's interest rate, or next week the interest rate's going to go up, or next month or next year. That's not as big a concern as valuations, and valuations for stocks at the moment seem to be a little bit stretched, and when we go through some individual examples I'll show you that. So let's presume interest rates are going to continue going up in Australia. When I value a company, I'm using a 9, 10, 12, even 13% required return, so I'm giving myself a little bit of a buffer there anyway for interest rates to go up compared to where they are, and using those sorts of numbers, the market seems to be a little bit ahead of itself. So if interest rates do go up, it might put a cap on our market. Okay,
let's go from interest rates to the gold price, because it hit another record today. This is the way the gold price is trading right now, $1,188.10 US. These are the gold stocks, the major gold stocks listed on our share market today, all doing quite well. How much of this record that we're seeing lately anyway is it have to do with demand, and B, how much has it got to do with the weakness in the US dollar right now?
It's mostly weakness in the US dollar, but it's a combination of that and the fact that we're actually seeing a lot of money being pumped into banks globally. That money eventually finds its way into some asset classes I mentioned earlier, be it the property market at the end of at the end of the 1980s, be it the stock market at the end of the 1990s, and it appears that this decade it might indeed be commodity markets. And I would argue that it won't be just gold, that it'll probably be across a lot of commodities, not only gold, oil and softs. The food and the grains complexes, and so I think that we're going to see gold probably go higher, even though it's sort of mucking around with it, or if you like, it's flirting with all-time highs. The reality is that on an inflation-adjusted basis, if you believe in that, it's actually 50% below its all-time highs, and silver is 90% below its all-time highs. So I'm not an expert in commodities, and I don't claim to be, but I do follow people like Jim Rogers and what they say. They seem to make billions of dollars trading these things, and their view is that there is a bull market going on in commodities.